I apologize. Let's wait until our other colleagues pull up and we'll start. Let me say a few words. Thank you again for accepting our invitation. We have completed the list of participants. Thank you for everyone who RSVP'd. We will use the same list 4 times a year. Once we publish the monetary policy program, we'll send out invitation notifying you of the time. The hour will be mostly the same as well as the venue, but we'll still inform you and send out the notifications. As for the language, last time we talked about it, you remembered it might be possible in English. We follow the following logic. There are quite a few colleagues abroad who have an interest in it, so we decided to proceed as follows. The presentation, the slides is in English. The exchange will be in Armenian with live streaming also having an English interpretation. So we'll test this setup, and if there will be colleagues who will join us from abroad through this or other channel, we may reconsider the language of conducting this talk. But the streaming will have interpretation anyway. responding to our invitation. This is our second meeting, and we would like to present to you the monetary policy outlook. The central bank is represented by board members Narek Ghazarian, Haik Avetisyan, macroeconomic department head, and Vazgen Pavosyan, monetary policy department's macroeconomist. After the presentation, we'll open the floor for Q&A. Before asking the question, please introduce yourselves into the mic. Like Mr. Avetisyan said, we have simultaneous interpretation, and we need it for interpreters to hear. Thank you. Thank you. I will submit to you the monetary policy outlook report, which is fully in line and included in the monetary policy program, which was published yesterday. I hope you have perused it and are aware of what's it about. We will mostly reflect today on the developments underlying, including the risks, uncertainties and scenarios that were the basis for the monetary policy decision. Let me start with the first part, as always, reflecting on global economic developments and the scenarios or risks that have come about in the global economy and were ascribed importance in our decision making process. The high rate of economic growth in the US persists. Mostly, essentially, one may say they are moved by the demand and private consumption, which continues to accelerate and is reflected in the labor market, where essentially we still continue the high growth of 4 to 5% of wages, although unemployment is somewhat on the rise, which at first sight sends certain signals for market adjustments and stabilization of demand, but essentially the pressures continue to persist, which is reflected in the inflationary behavior. If we look at the commodity and services markets, where we have targeted 2% in the event of United States, we're continuing to hover around 4%, which is fully in tune with the developments of the demand. These phenomena are still observed. The American economy assessment for Q4, it has a trend of persisting high growth, most probably determined by the demand factor. Concurrently with that, the Federal Reserve has already taken the first step to reduce the interest rate, but after that decision, in the wake thereof, as well as following the presidential elections, the Federal Reserve System interest rate expectations in the financial market were adjusted upwards. Prior to that, the labor market developments were leading to think that a faster decline in the interest rate was possible. If you see, as of the end of September, the expectation line was quite low. After that, following the Fed interventions, the first major step it took, as well as new information becoming available in the market, gradual adjustments were made towards upwards of the expectations, especially in the long-term rate, in the prospect, which is reflecting the uncertainty not only in the development of the demand, which we already touched upon, but also the a factor that determines the demand, essentially depending on the outcome of the presidential elections. Although, irrespective of the election outcome, both candidates had fiscal policy expansion signals sent. As a result of elections, we see that all of the predictions about fiscal debt level, it will substantially is expected to substantially increase in the 5 to 10 years horizon. The markets see this as a certain uncertainty as to how it may affect the long-term neutral rate, especially the risk of the debt, which is the basis of all the market signals that we observe in the Fed, especially long-term rates. Nevertheless, we have to acknowledge that concurrently with the reduction of inflation, the market expectation are focusing on gradual decline of the interest rate, and this uncertainty mostly pertains to the long term. The international neutral rate and the Armenian neutral rate are affected by this uncertainty. In the EU economy, essentially, the slow growth rate in the EU continues. In Q3 we have the update. There is a certain acceleration of the growth. What's interesting here is that up to the Q3, if the main locomotive of the growth, low growth, close hovering over zero, the main locomotive of it was external demand, export of services and goods. In Q3 there was a certain shift, and the external demand, net exports are become negative, and the main increase of the demand is accounted for by domestic demand. In different countries there is a whole range of factors that affect this. The EU, after all, is not homogeneous. It's a group of countries that have even different structures of their economy, but this is also reflected in certain messages for the monetary policy. Even given the slow growth, this line that the ECB has proposed, whether it will have sustainability and what type of a continuity, especially if it's already domestic demand that came to the forefront. The EU, we know that the main issues in the economy pertain to the prospects of potential capacity growth, which are mostly determined by regional developments and the new realities which pertain to commercial trade restrictions, possible escalation of trade wars, you name it, which as we know, the EU economy is mostly oriented towards exports. The main countries, Germany, France, are like that, and on this background there are new risks emerging for slowdown of the economy. The inflation is also slowing down, but like in the American economy, in the EU, the services and sticky prices still continue to be high, and this is another challenge in contributing to uncertainties in political decision making. Another global economy demand discussion which we want to draw your attention to pertains to the developments in the Chinese economy, which concurrently to the EU economy is another source of global economic possible growth slowdown. The uncertainties persist here as well. The real estate market developments within the last 2 or 3 years were the biggest vulnerability of the Chinese economy, and this detrimental phenomena still continue. We see that there is a slumping of real estate prices. They have not yet sorted this out, and the demand is quite weak, which is reflected in the inflationary environment. For 2 years running, the inflation is close to zero in China, which not only exercises certain pressures on exports, but also identifies risks that may emerge in the future in the significant slowdown of demand in the global economy, which is not altogether impossible, and the Chinese economy may contribute to that. Although all policy interventions, fiscal and monetary, that the Chinese authorities put in place, the risks of future inflationary and weakening demand still persist. The main challenge of the Russian economy naturally is the great fiscal expenditures and the challenges that poses to the monetary policy. As a result of great fiscal expenditures, although the central bank continually increases the policy rate, the high demand determined by fiscal interventions pushes the inflation upwards, and there is a great risk of decoupling of inflationary expectations. And the sanctions on top of that, alongside the restrictions, they regularly affect the level of uncertainties and volatilities in the macroeconomic. We recently saw the incarnations of this in the financial market and the macroeconomic environment. The volatility increases, which may become grounds for certain de-anchoring in the financial market. As I mentioned, the main challenge is still monetary policy. The possible anchoring of the inflationary environment, the uncertainty risks are high. The signal of the fiscal policy to move the economy in the positive direction is the main locomotive of the high economic growth. Reflecting on the commodity markets, which are important in formation of our inflationary environment, the food prices have enjoyed certain stability for quite a long. In 22-23, following the significant decline, there was certain stabilization, and in the most recently there are certain signals towards increased prices. Several commodity groups, mostly dairies and vegetable oil markets, push it forward. You may remember during the previous discussion we identified that the main risks are twofold of the commodity markets, because the demand factors originating in China and the EU are mostly push it downwards. But since these markets, one may say, after certain adjustments are at a certain balanced domain, any information may result in risks in both directions, which we will regularly encounter. In commodity raw inputs, there is more grounds for volatility. The oil petrochemical market contains risks in view of the Near East conflicts, and generally the sanctions against Russia and other developments have led to significant shocks in the commodity markets, and this may become the source of uncertainty and risks in moving these markets. Risks along these dimensions in our assessment, like I mentioned, are twofold. Both upwards and downwards we may see shifts. downwards. Mostly, like I emphasized, it would be the demand originating, weakening of demand from China and the EU. The conclusion, let me quickly move. The main challenges I mentioned, the financial markets, monetary policy outlook, resulting in uncertainties about the neutral policy rate, determined also by the fiscal policy. China is the main source of forming the slow demand, and the risks are there mostly. The Russian economy signals are mostly determined by volatility, inflationary risks and uncertainties, as well as in the commodity markets. Like I said, they're mostly great twofold possible risks: volatility. It's not the emergence of scenarios in any directions, but mostly volatility that we deal with. Current development of domestic economy. Let me start with the capital markets. Important indicators: the sovereign risk assessment of the country that was discussed. We see that in the recent years, we may say relatively low, about 300 base points hovering risks premium. It remains and persists in various situations. There are a whole range of signals. The last time we talked about possible adjustments, getting closer to the long-term level, possible scenarios thereof. Today these scenarios have somewhat weakened, but we see that in view of various regional developments, including the ones in Georgia, may lead to certain shifts here as well. The main scenarios or uncertainties here are again determined by our geopolitical internal domestic economy developments, as well as the regional geopolitical developments, which may mostly exercise upward pressure on risks, as well as determined, like I said and like we discussed the last time, by the adjustments in the American economy and adjustments in the international financial markets on the background of the normalization.
That's where we might consider risk overpayments in terms of normalization, long-term fundamental level insurance, possibly return to these levels. That's what it's related to specifically. All the other signals that you could be observing here. This way or another, our conclusion is that the overpayment is still quite restrained, and that might contribute to the capital market financial involvement. In terms of financial flows coming to the capital market. As for inner or in-house situation, is still being very high. Well, slowing down, but still remaining on a high level in economic growth. So high in the sense that the long-term potential assessments that were around 5% are currently there, meaning growth still there, around 5%, and as regards economic activity and economic growth respectively, the situation is the same. And the main locomotives here, the main developing sectors, as you may know: construction, trade, with respective developments, and services, and services in trade that also contain signals of some positive environment, specifically for supply. We've been looking into different scenarios here, one of which is kind of standard scenario, and that's specifically related to the longer term persistence of the demand. and the main signals in fact are emitted from there. The fact that economic growth has to be adjusted to a certain extent, because we've been saying that this is in fact deriving from the previous years. Nevertheless, that adjustment to a certain extent might slow down as well, which might seem positive at first glance because it's growth, it continues, but at the same time it contains risks pertaining to the demand and inflation. And one of the determining components behind growth, and we've conversed that previously naturally, is the foreign trade, so-called import-export parallel, with all the positive effects deriving from there that still contribute to the economic growth. There was a significant alteration there after first and the second quarters, but apparently still remain as the main factors of growth of our economy, though smaller obviously, but still playing an important role, contributing positively to progress. And of course, if conversing the more conventional kind of traditional branches of the economy, specifically manufacturing or industry, we may see here that the traditional export, like mining, well, no, less the mining specifically, this is mostly food, obviously, so tobacco products. They're under one category, by the way. We've been having some positive trends there as well, specifically in the last several months. Well, of course, volatility is still remaining, with significant risks persisting, but nevertheless, there have been some positive trends we've been observing, both in terms of productivity and export, that might also contribute to longer-term growth, meaning add to the potential in terms of production and export. But nevertheless, the main driver in the growth of the economy is construction. Might be certain risks there as well, can slow it down. There were certain signals emitted already, we've been observing them as well. I mean, it's not slowing down in the bad or negative sense, but in the positive sense, I mean, adjustment-wise. Because you know that leaps here are not always perceivable decently, and I mean sometimes they may also mean the share of the subsidy from the state. So at the moment you remove the subsidy, there might be certain readjustments. Those readjustments might not always end up with the positive balance. And we may also clearly note here that other parts of construction, the construction sector, which are related to the public investments, they are still growing with big leaps and contributing to the economy respectively. Nevertheless, in residential construction, adjustments are not yet happening in the smoothest possible way. If I try to sum that up, well, not sum that up, I should say, tell you what the main drivers were. Well, apparently these are more in-house demand that I've been mentioning before, but the external demand that has been one of the main drivers for 2022 and 23, that also includes remittances. And by the way, we've been slowing down there as well, though parts of remittances slowing down. There were two possibilities we discussed previously, and we're currently in the corollary of the same discussion, with the same uncertainty remaining, in the sense that we may elaborate a fundamental possibility there that's related to less migration, meaning influx, and more outreach opportunities. So in this case, the main driver was the factor of relative salaries or payroll between the two countries in 2023 that had significantly been reduced, and we may only have supposed that it was because of the migration flows shrinking. Well, some adjustments have been done recently, but it's still on a low level, and it is still possible that less remittances are related to more fundamental factors. Nevertheless, we've been also stating that the other possibility is that in real life, in fact, the remittances are still the same volume. Maybe it's because of statistics, and there could have been certain problems with identification of statistical information and combination of reports. So we're just trying to statistically understand cash remittances. Maybe there are a specific way it had grown in the formula. Why? Because in fact, if we just look at statistics, dry statistics, they say that there are less remittances inflowing the country. Meanwhile, there is also significant growth in the range of error in calculations or estimates, which might also mean that there have been certain remittances not taken into account in the formula. As you look at the fiscal situation, the inner market, then you might find some answers to this, which also means that there could be certain developments which would have changed the overall picture with outflow of currency and inflow. I mean, meaning that the remittances in fact didn't shrink, but it's just a statistical error, as mentioned again. We have to look at this in more detail, I suppose, just to clearly identify the possibilities of growing in the cash sector, just to try to understand the overall size. So, for the overall weight is about 15% of share in the overall transactions, but in the last quarter, specifically this year, there could have been certain additional adjustments, and we'll have to course that later, see how it has worked, and we'll be reporting on that later as well. Now, as regards the next point, I mentioned that for foreign demand, those components had slowed down as well. Well, some of the main components providing for the possibility to adjust were based on the inner demand, and here we're looking specifically at the sources. I mean, trying to understand causality, and we've been observing significant growth in the part of the loans and mortgages, specifically the part of mortgages especially, and the deriving consumption. But there were certain growth trends identified, but obviously we have significant growth in business loans, and some of our surveys among financial organizations have proven that these trends are based on demand and supply at the same time, and maybe because of certain extenuation in the terms for issuing of the loans, and respectively expectations are more towards the positive, from the commercial banks. And the work will continue here, of course, in the nearest future at least. So the main conclusion here might be the following. According to the assessment that we have conducted, growth in loans market specifically emanates from the larger demand. I mean, this is a phenomenon that mostly emanates from demand. Meanwhile, maybe extenuation in the terms for provision of loans also plays a role here. So I mean, it's not because of the supply, but because of the demand. It is the demand that moves the pace or fastens it in the crediting sector specifically. Now, as regards uncertainties or risks that we've been identifying in the sector, these are specifically related to 2025 and midterm fiscal position, because we know our fiscal situation, because what we have seen maybe tells us that we are going to be having some impact in 2025, so there might be certain additions to the spending, but the main uncertainties are rather related to the risks, and maybe there are certain developments taking place, including revenue collection, and for the revenue collection we may suppose change in the structure of the spending as well. So we might be summing up some of these parts several slides down the road, and obviously our estimates here are two-tier. In fact, they're based on demand, but they're still two-tier. So there are certain risks and uncertainties which prompt to the fact that the signals might be much larger, and specifically in the midterm we see some uncertainties with the trajectory of the debt, specifically related to revenue collection and expenditure policy in parallel to that, specifically related to increase in ongoing expense. By the way, we have to be looking at the challenges that we have already been seeing, and we may suppose some additional challenges in the nearest future. You know what's happening, what has been happening in Lebanon and Syria. There's a probability of some of our compatriots coming back to Armenia. There are certain risks and uncertainties related to that, and additional spending from the state budget expected. Meanwhile, we have considered scenarios that might be rather restraining and can have certain influence in this regard, that specifically emanates from the expenditure policy or specifics in the expense structure. We've been observing increase in the capital expenditure by the government, specifically related to commodity markets, and the government is currently trying to explain that, to explain the deficit by more investment in the commodity markets, and it's not going to have any reverse reaction because revenue collection is going to have the restraining effect. But as regards the expenses, then the reverse signal is not going to be going towards the economy. So apparently we're exposed to higher risks. So we'll have to see. This way or another, there are bilaterally going processes here. Now, as regards the developments on the labor market, then we've been making some general adjustments related to the general demand, and we've been observing those as well. It is well reflected in the salary adjustment attempts, which have been quite significant, 2022 and 2023, from 10 to 30%, by the way. This is quite significant. We have currently 4 to 5% growth in the salary, and that's quite in more concordance with the overall productivity indicators of the economy, and this is one of the indicators that we've been looking at, which once again shows that the economy is currently much closer to longer-term potential. Meanwhile, we have also considered possible uncertainties regarding those estimates and indicators, specifically because of statistics. So there are two types of statistical information appearing here. One is the official statistical information from the Statistical Committee of the Republic of Armenia. The other is statistics produced by the State Revenue Committee. And there are two different signals produced thereby. One stating that in terms of employment we have either growth or reduction, and in fact there have been different interpretations. We've been saying that it's also due to reducing the shadow, meaning unregistered workers currently, and that could be one of the drivers. On the other, there could be a problem in terms of insufficient protocoling of the situation, I mean describing the situation. So both signals are quite relevant, quite valid in this situation, meaning both could be considered in making respective inferences, and we might even see reduction in demand, which means more unemployment. So we'll have to once again record the indicator, and possibly we're quite far from having a balanced labor market at this moment, and growth and employment opportunities continues, in fact. In parallel to that, we have to speak about an important factor that has been discussed before, and it is specifically related to supply on the labor market, meaning the demand for certain types of jobs has been fulfilled by some immigrants from India. Meanwhile, some of our compatriots didn't this time use the opportunity of outreach employment in other countries. They stayed here, and also some opportunities were created for our compatriots displaced from Artsakh, and we are still exposed to a number of uncertainties because of the influx from Syria and Lebanon, also the growth in the number of people coming from there. So that also contributes to significant uncertainties that we already have. On the one hand, through the discussion at the board, we in fact stated that these risks essentially uh, are rather obscure, unclear, meanwhile also milder, because we've been seeing some emigration of Indians from Armenia, and that has significantly contributed to further adjustment of the demand. So we may observe some possibilities of solving issues in the longer term. The other issue related to the compatriots displaced from Artsakh and their integration, we've seen that the integration in the primary phases has been completed. It's been has happened already, but still some of the results are not very satisfactory. Meanwhile, they may also be not very accurate, specifically related to employment. Now, as for the inflation, in November we made the respective adjustments in general estimates of ours in accordance with certain expectations. So it is 1.4%. The natural process has not yet been clearly assessed since November. By the way, the main adjustment factor here is fruits and vegetables, seasonal products. Though, in parallel to that, there are also non-exportable products. These are usually services in a less flexible price policy, so the inflation persists there in kind of normal ranges, 2 to 3%, which is more concordant with the neutral environment of the demand that I was just talking about. I mean, coming closer to the more balanced potential in this regard. So, I don't know, yes. So, the main component I'd like to speak about here, depending on commodity markets, international commodity markets, in the last year and a half, the main driver pulling the demand down was the imported-exported goods. We have been through the process for a whole year and a half even, and we've been observing some recovery there, positive adjustments, and the main challenge that we've been facing in the monetary policy specifically was the low inflation environment, specifically pertaining to the imported goods, and in parallel to that it was the issue of positioning of our monetary policy respectively. So we were observing that the low prices were mostly low inflation was specifically related to imported products, and some of the sections there are still relevant. We may say today that there is significant success here, and the inflation-related environment is transforming in an expected manner, and there is also the inflation component that has been taken into account, and currently it is closer to the targets and maybe even lower than that. So the main driver or the driving component for inflation currently is import, and we have been looking into some possibilities for growth there. So the issue is that when the inflation is clearly adjusted, we will have the ability, we will see that it's being adjusted, coming closer to the target indicators, respectively exposed to less risks. So with less probability, we might appear in the upper ranges. As for expectations per inflation, there have been certain positive developments in the fourth quarter, well, closer to the end of the third quarter, and some surveys carried out in the fourth quarter, asserting of the fact that there are less uncertainties here. At least some processes there have slowed down, and mostly this is because the specific weight of those we expect lower inflation has grown, which is also a positive signal as such, specifically related to the inflation. Now, as regards the overall economic situation, well, there are quite significant uncertainties there. There might, though, be a very general estimate to say that the economy in Armenia is closer to its neutral stance, meaning closer to the balance in terms of GDP deficiency and with respectively that has been covered. So, and monetary policy is also close to neutrality. So uncertainties I already mentioned. There have been several components. One is the interest rates in the United States with the respective midterm traceability, and of course the risk related uncertainties. There are in fact two different groups of uncertainties that in fact determine the longer term monetary policy risks. Though at this moment, per the assessment that we've made, the monetary policy in Armenia is close to neutral, which is in harmony with the overall, more in balance with the overall expectation for the development of the economy. And the same is also related to the currency. I mean, certain monetary policies. And some of these uncertainties have persisted just because of more recent economic effects rather than developments, because the main issue is still whether developments in the most recent time were the reflections of higher productivity or higher capital, or were just the derivatives of provisional demand with respective popping up factors that are ephemeral and might not withstand the test in the nearest future. So depending on that, the further uncertainties will remain regarding currency rates. So that's mostly emanating from the market desire and expectations in the market, and there is a trajectory we think is more in harmony with the statement that the larger share of these phenomena, well, not the larger share, but part of them, it was just consequence of this provisional approach and would then be adjusted gradually. And it's also interesting that the expectations of the market players are adjusted upwards, which once again describes the uncertainty environment emanating from the scenarios that I just mentioned. So the market players here as well try to reassess the situation, reevaluate the situation, come up with certain forecasts for the development of the economy. We're kind of expecting adjustments for the economic growth, but the economy continues growing significantly and may be emitting signals that we have to deal with higher level of productivity, possibly higher level of productivity, with an economy based on that. So these adjustments have been regularly produced on the market, and these signals have been taken into account and integrated in our discussion. And expectations of the market players regarding inner policies on the interest rate, well, in the coming year we have already said that we are going to be looking at this with two different approaches to it, two different tools to be applied. So one is in fact a very clear expectation from the market, very clear estimates. These are in fact the income curve. And on the other hand, these are surveys held among the main market players, the main participants. So we've been considering these opinions significantly. We have been giving importance to them, to all the information inflowing, and we have been also considering the possible premiums on the market and the bonuses, and that might also have contributed to the change of the profitability curve. These are also very important signals for us in discussion of the monetary policy of the country. Nevertheless, per the surveys carried out, inquiries, in the coming 3 years, the market players expect gradual reduction in the monetary interests up to 6.5%, and according to the surveys and inquiries, and per the resolution made yesterday, 80% of the market players were expecting 25-point reduction and in fact it was satisfied by the board, but I will come back to the reasoning behind that decision a little later, so that it's clear why it was 25 points specifically. And as regards the coming year, meaning till September 2025, this is going to be 6.25, 6.5. That's at least the expectation of the main players on the market, and you can see the distribution of opinions. The next macroeconomic environment-related expectations specifically underline the currency rate discussion here. This is both the interest rate and inflation and currency. So per the surveys we have carried out in the fourth quarter, we have found out that it's more going towards reduction, and I mean that's where they see the adjustment downward adjustment, and in fact it is because of the short-term period for the defined monetary policy and interest rates. I mean the trajectory was in fact showing the process going downwards, and apart from the shorter term there are no additional adjustments for mid or longer terms respectively. And in results, well, of course we discuss different scenarios, and some of these scenarios are here. I hope that you've been observing that, and in our monetary report these are the main scenarios that the board has discussed, and I will just mention some of these very quickly. So the scenarios were discussed in two main directions. These were scenarios in which case the board would in fact follow a stricter trajectory and decide respectively, and of course scenarios that would have moved the process towards reduction, meaning those increments would have in fact become smaller, and there would be more aggressive reduction. Now as regards the main scenarios, it's the A type, or specific stricter scenario, that first of all emanates from the United States policies, specifically long-term interests, traces and trajectories that I mentioned.
It's an important component of the interest rate, and the main uncertainty hinges on that. All the risks that may suddenly erupt when in the States the interest rate is higher and we go for faster reduction scenario, and that will contain significant risks in terms of demand. There are scenarios that pertain to domestic demand drivers. We have uncertainties here, especially I mentioned the current demand environment assessment. It's still higher than the potential and is moved by components of demand. So are there any risks that this demand is positive and continues to move? The lending and growth factors, fiscal policy risks that I referred to are present here, as well as accumulated savings over the previous years that are still higher than their historical averages. They could also create basis for continual growth of consumption. These are all factors, sources that may drive this scenario, one may say, or contain signals. Therefore, the other factor that the board has looked at is the uncertainties about inflation expectations. There are high uncertainty here, and it still contains risks, especially if it is concurrent with the demand risks. There could be certain adjustments. In the A scenarios, there are certain supply factor scenarios that we looked at, in particular the production and trade chains disruptions, determined both by regional tensions around us. There are two different regions, I apologize, that have events unfolding which may cause significant disruptions, especially in commodity markets, and also determined by trade policy, global trade policy. US, China, EU, and also other players may enter the trade wars, and there could be possible fallout effects that may disrupt various factual production chains, increasing the costs and exerting inflationary risks. Concurrently with that, there are B-type scenarios we looked at. Ancillary to this, it is possible that in view of these trade disruptions, especially in consumer goods, there could be a certain surplus production and stock, as well as services, not only goods, maybe or supply, which may have risks of falling prices. So the board looked at both possibilities. In B-type scenarios, I already flagged the main issues: global economy risks, falling prices. These are issues originating in Chinese and EU economies. Another thing which we looked as a model scenario is our domestic construction sector adjustments. Natural adjustments are already underway in the domestic construction sector. Concurrently with that, there is a possible macroeconomic impact. We're talking here about something which, as opposed to previous adjustment phases in the construction, 2008, 2014, and etc., where the macro effects, apart from the construction per se, they were weaker. Other macro effects, here it is possible that today's situation may slightly deviate from that. For example, in the lease market, there is more people involved, and the real estate as an asset is being increasingly perceived more as a collateral real estate. All of these dimensions may have much larger macro effects originating. We're talking about the possible impact on macroeconomic consumption. We're talking about normal adjustment phase and larger macroeconomic effects therein. We naturally discussed risks in the labor market, which I said has uncertainties persisting. There are fiscal risks that I already flagged as well. Essentially, I covered that. Yes, and one more important risk that was discussed at the board is the persistent inflation as a background may result in certain emergence of certain scenarios of decoupling expectations downwards, which was also pivotal in the discussions. This summarizes all the scenarios that the board discussed in order to take its decisions. Two model scenarios I already quickly reflected on. The first is model in terms that they are not more important, it's just a simple selection choice from the selection of other scenarios, just to illustrate what case A scenario is. It's not that it's more probable or more weighty. In the transparency report we published yesterday, you may see that there are board members who, in discussing case A or case B scenarios, didn't even reflect on this illustrative models, since they didn't consider them important enough. So since our meetings are relatively new, I want to reiterate and emphasize one more time that these illustrative scenarios are just for illustration, not because they matter more in the policy decision making. Every member of the board singled out what he or she deems to be more important, and there are reflections on this in the transparency report. In case A scenarios, when we deal with the more positive possibility of formation of a more positive environment, we are already talking about the demand already being close to a balanced level, but we also talked about various uncertainties here, and the growth is higher than exceeds the potential. Maybe that's not the case. Maybe the background is still positive for the economy. There are drivers for this: the savings, the increased lending, and fiscal policy risks that are possible. These are all grounds that allow us to project higher demand environment coming forward. If the case A scenario develops, this means the interest rate will maybe stabilize or somewhat grow down going forward, which may adjust the current demand and maybe ensure approximation of the inflation to the target. The risks that may emerge from this demand coming forward may be managed. Case B scenario illustrative as well. This time we reflected on adjustment, the results of the adjustments in the construction, wealth and income fallout, and possible macro impacts. Let me emphasize once again that we're talking about normal adjustments, whereupon which we observe and deem it to be a normal phenomenon, and we're talking about its possible macro effects. As a result, there may be a certain negative environment of the demand coming forward. Wealth, income, and real estate. Expenditures on real estate. And if this environment comes about, negative demand that is, this will also mean that the board, quote unquote, will be more aggressive and take bigger strides in reducing policy which may be adopted in order to be able to manage the to take the inflation closer to the target value. I essentially, by way of conclusion, these are the illustrative main scenarios and the discussions that took place in the board. Let me once again emphasize that all of the scenarios we presented, case A and case B, are the scenarios that the board has discussed as a foundation for its future decision making. The final decision, which you will have an opportunity to dwell more on in asking questions to Mr. Vazarian, who represents the board and its take on it. If you look at the final decision, you will see that there is more of a probability of case B scenarios materializing. There is more likelihood, but the impact on the economy and possible risks result in more concerns about case A scenarios. The decision is 25 base points, which were mostly determined that it may materialize faster reduction scenarios, but the risks that are higher in a case A scenario, so we need a phased-in approach, which took place. In the board there were also certain divergence in approaches. Since we published it yesterday, I would like to draw your attention to this as well. There were three types of approaches. Express one is the group, the majority that I just told you about. The second group was more inclined towards the case B scenarios and their impact. They were more concerned with this, and they proposed a faster response, 50 base points. And there was one board member who was also a 425 base point, but he didn't share the concern, they didn't address the issue of the first group, flagged by the first group. He mentioned that all risks are more balanced and the scenario more in harmony with managing all risks does not result in major controversies. That's about the final decision. I will conclude at that. Thank you very much. Yes, Mr. Vazarian, your take on the decision. Thank you for enjoying my presence here. There are two important factors about the monetary policy carried out by the central bank. First, it's forward-looking and it is operating in conditions of uncertainties. The best way to manage these uncertainties is analyzing scenarios, discussing various risks in the context of inflation. Mr. Afetisian dwelled at great length on all these risks. Case A, risks that may result in undesirable high levels, both from the probability of materializing and the impact, and B-type risks which will result in undesirable low inflation. Based on its mandate, we are bound to respond to both developments forward-looking, because there is a certain time lag associated with our decisions. Considering the risk map that was exposed to you, the board decided to reduce the refinancing rate by 0.25, setting it at 7, down from 7.25. As representing the board, this is my take. The decision was taken by board, and I'll gladly entertain your questions after this. Let's start from this side and take turns at the mic. Narek Mukarchan from Arad Bank, thank you for the expose. I would rather like to ask a question about the general system, since this is our second meeting. I wanted for the year to end to look in retrospect at the activity of the central bank through the year. What's your perception? What would have hypothetically the board of the central bank done had we not transitioned to Mark II, if we didn't look at the plethora of scenarios, but were rather guided by one baseline scenario without too many detail? And as a board member, I would like to ask a question to Mr. Vazarian. Have there been cases in the past where the risks that were a matter of concern for you were not captured or addressed duly in the previous system, whereas that has been addressed now? Thank you for the question. Quite naturally, in a formal sense, we have been internally, and hopefully sometime down the road we'll also publish such analyses. It's not a result of the shift in the system, but also the increased accountability of the policy. Which were the accomplishments of the policy? Where were the improvements accomplished? As for the question in particular, had it not happened, the shift to the Mark II, this is not relate. Of course, it affected the quality, increasing it significantly, because in our observations we're trying now to focus more on all possible options and the risks, rather than focusing on the risks of one scenario. Uh, this allows us to conduct broader discussions prior to taking the decision, in particular as to what is it that we want to manage, what we think is the priority in managing. Whereas in the previous setup it was far more important to look at what was the most probable development in the economy. This is a major difference in the decision-making approach, which you can't compare apples to oranges, of course. You can't make a direct comparison with that and these systems, but there is an important distinction that in decision making we do not look only at probability of certain things materializing, but also the impact, and we look at what issue we want to address and manage. And all of our communications, board decisions and scenarios converge on that. That's as to what would hypothetically have resulted, could be the hypothetical result of this if we looked at the conventional baseline scenario, which we could consider conventional. This is the financial market participants baseline scenario. We would see there that the participants of the financial market also have reduced downwards their expectations. So this was it contains twofold signals we take from the market as to why do we expect downward developments, and maybe should pay more attention to. And secondly, all of the messages that the board in its decisions and transparency reports sends. Do these messages nudge the market to some extent? Did we succeed in conveying the nudge we wanted to the market? The main issue of monetary policy essentially is communicating, conveying messages to the market, which by the end of the day will contribute to our inflation target accomplishments. We change these nudges, shifting from probable scenarios to the important risks that we want to manage. If we look at the comparison with the markets, maybe both have been taking place concurrently. It would be difficult to delineate one from the other. But let me reiterate an important emphasis. The expectations of market participants, which are quoted through their selection of financial instruments, are now the most important and have an important actual role in our system now. The difference between Mark 1 and 2 may be exactly in that. A year ago we just looked at what the market expected. It would be just the counterfactual analysis results that you alluded to. I will perhaps emphasize Mark II strengths, and we'll try to compare it with the counterfeit action. In this concept, under this concept, both the members of the central bank board and the analytical staff determine all case A, case B scenarios and are not bound to select from among them the most probable development scenario. We are not bound to select the most probable scenario that would have come about as a result of combined risks. Selecting the most probable scenario to some extent limits you in decision making. But we should emphasize that the other risks are not looked at in selecting the most probable scenario and are not commented. In the old approach, we always analyze the alternative scenarios and the risks associated therewith. In this approach, the advantage is that we formally take case A and case B risks and analyze them. Every member of the board, having gone through and perused the analysis submitted by the staffers, selects in his or her opinion the most probable of those risks and the impacts, and as a result of balancing between these two arrives at a decision. So it's factoring in formal risks without being bound to select the most probable scenario that and clinging to it thereby to some extent, because if you select one, it makes sense that you ascribe more weight to that scenario, and that resulted in certain deviations from communication perspective. If we communicate a baseline scenario, the popular perception is that it's the most probable. It's very important for the system also to weigh in those risks, whether upward or downward. As a result, a decision should be made, which is most important. The board took a clear decision to reduce it from 7.25% down to 7%, and this reduction cycle, once we commenced, we started from 10.75, we're now down to 7%. In comparing numbers, had we not had this framework, most probably it would still be the scenario of reducing the rate, but our opinion is unquestionably that this framework results in more effective decision making. Next question. Thank you, Ignat Frankian from C Quadrant, Ampeg, Armenia. My question pertains to new policy target, the 3%. When will this become valid? And in all other things equal, in your assessment, what would be the implied neutral rate in that case if we move to this new target? Thank you. Thank you. Formally, in reality, like the law on national budget states, the assumption is that starting from 2025, when we have published our first decision in February, monetary policy decisions will be extending to a 3-year horizon, approximating the inflation to the target. That's what it formally means. Since February, as a guidance, pole star for our decision making would be arriving at the target of 3%. As for the neutral rate, of course, its impact will be positive. If we're talking about nominal neutral rate, it will go downward. The rule of thumb assessment is 1 percentage point, naturally. But let me say that this is a theoretical assessment. The rest will depend on the work that we published. Also reflects on that, contains a discussion on these matters. Everything will depend on the state of the economy, the baseline state of the economy, the level of trust towards the central bank, whether there would be additional efforts exerted by the central bank required to make it happen, or is a statement sufficient for the market to adjust completely until we commence all of these? But we're already immersing into it. The market already is aware, it's common knowledge that starting next year our decisions will follow that logic. On the fly we will get the assessments. Our assessment at this point is that the economy is already on a balanced level. The monetary policy position is almost neutral as it is assessed, so the economy at least doesn't pose any additional issues, but we'll understand as it goes. In all other things equal, theoretically it assumes 1 percentage point lower interest. The statement of the official statement of the central bank is posted on our website with all of its possible positive impacts and the technical rationale and the work that became the basis for the analytical foundation of the decision. Let me fill in. Changing the target downwards from 4 to 3% essentially means that in the longer term all of our nominal indicators will bear the positive impact of this change along two dimensions, getting lower, and this pertains also to the neutral rate and all other rates, nominal component of other rates as well as the reduction in volatility. It's been proven that a lower inflation target results in more stable environment.
And we expect that positive environment to occur. So through change, we expect real economic growth, higher level of economic growth in the longer term. And just nominally, it's just a direct effect. So as Mr. Avedisan mentioned, this is just inertia, and it equals the nominal component. The nominal component is established through expectations. So we're trying now to move these expectations downwards, kind of being prepared for that, in our opinion. With that effect, we expect 1% reduction, 1% decrease, but we may also expect positive growth. I mean, since the economic growth can be higher, then it might go higher too. But in terms of expenses, in terms of losses, in terms of just nominals, of course, all the percentages we expect are going to be lower, because the expectation for the inflation is going to be anchored upon the point that it has to be lower. That's the mechanism, at least. Thank you. Please, next question. Arzuman Dalakyan, Ameria. In the statement you said there are certain risks and uncertainties related to certain sectors of the economy, meaning depending on how they produce through 2025. You mentioned construction specifically. Now I want to understand whether you have any clear estimates, any measurements. What do you expect? What's the baseline scenario for construction in 25? And in your opinion, how much would growth go down? So, and what adjustment of prices do you see in the baseline scenario for the construction sector? Thank you very much. I would have all the pleasure to cover this, but we don't have a baseline scenario here. We don't have the right to communicate the baseline scenario, at least. So, nevertheless, there are, I mean, if you try to imagine that baseline scenario somewhere, then we may suppose more or less activity there, distributed by scenarios that have been discussed, by the way. So naturally, when deciding an interest rate, the board considers all the indicators in terms of inflation, like developments in the construction sector are important for us, absolutely or exclusively in terms of impact on inflation. We may have other tools that might come forward. These are more macro-prudential policy related tools, and they are of different character, and it's a different conversation, in fact. So as regards this sector, the activeness or passiveness of the construction sector are measured regarding the impact on GDP. If it's more active when we go with the A scenario, then side effects might produce more aggregates and higher inflation. When is that possible? Well, if the economic growth is higher in other sectors, meaning more conducive environment and more inner factors, some activity in other sectors contributing to it, which ultimately produces demand for construction. And in that case, we might go higher fundamentally than what we expect it to be currently. As for the B-type risks, when discussing the latter, we take into account a number of indicators which in fact point to the higher level of activity, higher than the norm, which means adjustment downwards. So depending on the acceleration of the adjustment, B-type risks might be communicated to respective parts of the economy in different manners, to the financial system, to the private sector, to the consumers, to the enterprises. So when discussing B-type risks, we base ourselves on our analysis, and those analyses we have carried out show that level of activity is a little higher than the norm, and a downward adjustment is more probable. But please take into account that I'm currently mentioning a fundamental reason. If the economic growth proceeds in the upward scenario for 26 and 27, then for the sector it means a higher demand of this for the sector, and maybe some growth in prices. Just a short addition. As regards the main components of B-type scenarios, there may be various risks through the adjustment itself, but as regards the restrained demand, these risks might derive from various components, and specifically from adjustments of prices in the real estate market, with some negative expectations and plummeting income that might contribute to some negative demand in the economy. But if we are looking at this from the prism of supply, and we are currently trying to answer the question, since this is specifically related to construction of residential space, and just almost half of the total construction, then we should say that the overall construction growth might produce very weak but still positive growth. We may say 1.2% in 2025 for growth of the whole branch of the economy. Okay, just as corollary to that, and then we'll move to your questions. It was a different question, thank you very much, but we can go one by one ultimately. So, monetary policy quarterly report contains the situations in different cycles, the previous and the current cycle, and the interest rate change magnitude by the central bank, as well as the reflection on that or the reaction to that from commercial banks, which makes it obvious that in the current period the interest rate levels offered by the bank to the sector are less malleable. What would be your explanation for that? And would you call that sufficient in terms of effective policy implementation? Well, I'll go back to the analysis now. And then Mr. Ghazaran will tell you what's the attitude of the board to that point. I mean, of the policymaker. In fact, that analysis is, by the way, from the previous quarter. That analysis was, in fact, trying to show that the remittance mechanisms in the monetary policy should not be considered as the pivot. It depends on a lot of adjacent processes, and there are different cycles behind it showing which were the main drivers and main characteristics, and respectively those responses could have been different, and that was natural. That was natural. Now, as for the final stage, we have been mentioning that as well. The main phenomenon that we're discussing here emanates from the situation that the lending process with the overall components therein emanates from a larger demand, meaning it's the demand that moves the lending. And on that background, or in such a situation, naturally, the interest rates for the part of higher demand would not be fully emanating from the monetary policy. And it's not the same in the whole world. Like if you look at the perfect worlds, right? United States, for example, or in other developed markets, if you consider FED's interest rates, then you will see that it's just the opposite. I mentioned already the income curves and longer term interests going upwards. So essentially, we may say that it doesn't work in the United States, or it even moves in an opposite direction. So that's the issue. And you're then looking at the interest rates in the lending products, like the fastest responding to it, for mortgage, for example. Some volatility there. So the main message that we were trying to produce in that work was that we didn't have to look at these issues directly, kind of like black or white. We had to find the reasons behind the process, and I'm sure Mr. Ghazaran will try to currently tell us the opinion of the board. And we're trying to understand whether it would be possible or not, or would be enough or not enough. And maybe there was a need to be a little more aggressive or less aggressive in our monetary action. Thank you. Now, for the board, all the classical transaction routes are important in terms of the monetary policy, and lending is just one of those, because you mentioned that there are a number of very important directions, a whole list of different mechanisms that we use. So we're going to be discussing the lending part of it. The board gives a lot of importance to this issue, naturally. I mean, the classical transactional mechanisms. Now, if we discuss the interest rates for the loans offered by banks, then the refinancing rate, ultimately through certain adjustments and transformations, becomes one of the most important components, but not the only one. It's very important to mention. It's not the only one. It is also very important to say that for deciding an interest rate, the demand has to be taken into account. Just time-wise, I'd like to mention that specifically, because that's where we see the change. So Mr. Avitisyan mentioned that demand played a big role, a significant role, specifically in the process of deciding interest rates. The board is, in fact, in agreement with the point that it's because of the policies that we've been seeing recently. And that is why we have that respective demand for the products offered by the bank. And respectively, it's very important. It's also very important to take into account the volumes here. When you see a level of interest rates that is not low, meanwhile you see growth, I mean more loans issued, like mortgages specifically, or a lot for the businesses, then the board essentially starts to follow that very attentively, meaning there's obviously growth in magnitude, in volume, and that means that we have demand with the highest probability. We have growth of demand, and that is ultimately justified by economic activity. In this regard, our perception is the following, that if we hadn't had these increments of reduction, then interest rates could have jumped higher. I mean, could have been at least formed at a higher level regarding some of the lending products that you meant in your question. Another important point: interest rates are different. If you consider bonds and interests for bonds that are completely considered in the income curve with the maturities thereof. So if you look at the change, or if you look at the terms of that curve, then you will see that in the phase of reduction, when from 10.75 we went to 7, I mean, if you consider deviations of the curve in that interval, you will call them significant. And that curve, in fact, is without risks from 0 to 30 years. And I'm sure you know that that's in the foundation for deciding any interest rate. So there are respectively some positive effects through the enrichment process for different organization. I mean, that specific bond is more valued when the interest rates drop. So we have been seeing that. And then it all moves to the retail and wholesale, and I think that move could even produce a higher rate if we hadn't done anything. But this high level is because of the demand. I mean, all of the judgments take us there. And in this consideration, the board decided to go down 0.25%. And that's the consensus of the board. So it will have to be taken into account. So please. Thank you. My next question, related to growth from the second to the third quarter, we've been observing less economic activity. But in that period of time, by A and B scenarios for the monetary policy, there have been 1 percentage point growth. What happened in one quarter that is not reflected in the figures, but it in fact made you increase your estimate of growth by 1 percentage point approximately? Very quickly, about the system, and then Mr. Pogosyan will speak about the scenarios. So I would like to mention once again that the standard A and B scenarios, they are just standard scenarios. They are scenarios that in fact derive from situations, describe situations, and not necessarily should they go upwards or downwards, or in fact it doesn't mean that they have to be compatible or comparable to the former scenarios. That is why I will simply add a word to this. As a starting point for our discussion, for devising scenarios, we should be looking at expectations on the market, because this is more economic growth. So if former scenarios, upper right side, would expect more significant trajectories of growth than in the report that we've published yesterday, we considered lower growth, end of 24, beginning of 25. So these are scenarios with smaller growth. Now, the signals that you just mentioned were obviously reflected and in the market expectation scenario as well. But these scenarios are not comparable because they're not baseline scenarios, and they emanate from risk management, commitment, and that's the baseline, that's the benchmark. Nevertheless, Mr. Pavosyan, please. Well, Mr. Avetisyan has answered the question. I wanted to mention that too. In fact, reports, they're not comparable, meaning the medium-term macroeconomic forecasts are not comparable. And it's very important to understand the overall character of that scenario, meaning you cannot just look at it and say that it's A type. You should not be saying that it supposes higher economic growth compared to expectations or any other variables. I mean, it's not obvious at first glance. The only variable is the interest rate policy, which may be said, may be pronounced to go down or go up. Like if you look at the economic growth, then there may be scenarios of increased demand, meaning in that case inflation can go up. Meanwhile, there may also be staggering ones with lower growth. So it is not obvious here. In A and B type scenarios, you can suppose that directly. You can say that this variable is going to be higher or lower than the market expectations. Okay, so the board has noted the following. Economic growth has slowed down. That's a fact. While looking forward, the board came to a consensus and selected A and B scenarios that were communicated to you. Nevertheless, I would like to rule out the following inference. The board does not think that by looking at the future, then our perceptions of economic growth in any scenarios are higher than in the previous cycle. So I mean, if you have a baseline scenario, then you essentially move your forecasts upwards. We don't have that perception, but we have very clear scenarios, and in case they are a reality, which is not the highest probability, then naturally different members would have perceived it differently. However, there are scenarios where economic growth can be high or higher than it was predicted during the previous meeting. Nevertheless, to say that there is general consensus on the board that economic perspectives are definitely better than they were during the previous meeting is not the case. We don't observe that signal, neither we want to emit it to the market. In that case, if A type scenario is not anyhow feasible, then what are these figures for? Why are they at all published? And what's their application? Like, if they're not comparable, not feasible in time, then what do these figures mean at all? Thank you very much. Okay, in fact, there's something the market players should be following more scrupulously, and it's more related to the overall list of scenarios that the board considers every next time as a list that is important foundation for the decision making. Meanwhile, it is also related to the phenomenon of the risks that had to be managed, and that changes with time, and that's the monetary policy of ours. If you want to try to find some probable scenarios for the future, unfortunately, it's beyond our authority. It's not our task. Our task is more to discuss it with the market and try to understand why certain decisions were made. These figures we publish are in fact just groups or clusters of predictions. I mean, they should not necessarily be published because decisions were already based. So scenarios A and scenarios B are the standard scenarios. When we say A-type scenario, we explain what we mean. We say this or that, or we also say what would happen with that scenario, or what would you have seen in respective indicators, both in macroeconomic and in monetary policies. That's why that's not how that compatibility works. So if you provisionally conduct an exercise and elaborate a probable scenario, if you're close to this scenario, then these figures might be of use for you. However, we do not want to say anyhow in our communication that this or that is the right scenario, or if the board has decided this or that, or if these risks are provisionally or more probable or less probable, then that's how it's going to happen. Because in B-type scenarios, because the board said previously that the possibility of materializing for scenarios, B scenarios, is higher, and then the respective members could have made the respective conclusions. And not necessarily would those standard scenarios be default. That's the part of the logic behind the figures. when conversing usefulness of scenarios, it is very important to mention that these are tools for managing uncertainties by the matter of fact. So we also have published general judgments here, and with time there might be new situations, just in terms of figures, statistics, developments, and both externally and internally. And these developments mean that the probability for this scenario grows, meaning you're close to judgments. There are highers or lowers, or the current administration in the United States saying that they're going to be applying stricter tariffs in work with their Chinese partners, etc. So we're coming close to a scenario. Then the automatic interpretation of that is that the board is going to start acting, maybe by devising a stricter monetary policy compared to B scenario, which means reduction or maybe increase in interest rates. I mean, respectively, we would produce the route for the monetary policy. In this regard, scenarios are very useful because we see how the reality is rolling out and what has to be expected. So these are important, very important characteristics. But since judgments can be different from cycle to cycle, not necessarily would they coincide. And their main function is uncertainty management. Also regarding the market participants, and there are X judgments, and then you see that the reality is close to those judgments or estimates, and then respectively the probability of scenario coming forward grows. That's also the concept. It really helps in understanding the actions the central bank has to conduct next. Okay, just a small component, which is also a component of the previous system and is currently being more valued. I mentioned in the very beginning that that's what the monetary policy is about. It's for the market players to understand how decisions are made. So the standard scenarios are for that very purpose, so that we understand that if you are capable of devising a possible scenario for yourself, if you call that scenario more important, if you understand that that's what the board manages, then you will be capable of calibrating the decisions you will be making. So that's what the digital part helps you with, and it was true for the previous system, and it may be true for the current system, because there are over one scenarios here that we consider, which also allows for calibration of possible action in these or those scenario manifestations, and how it should be done. Because the goal is not to say that this is the most probable or the least probable, and it ultimately helps in building the right scenario. And if the board is going to be acting herein, then it will have to be taking into account the risks that it manages, that it has been presenting and regularly presents. So that has to be the composition of two, and that's what we expect from you in terms of working with the market, so that we discuss the possible future risks that you or market players might not take into account in their action. Please. Edgar Arabekyan, Armbrook Investment. I have two questions. One is reducing the target from 4 to 3%. Does the central bank have any assessments on how it's going to be impacting future growth in the medium term or long term? And the next, you mentioned that we're close to the neutral interest rate level, kind of. So bringing the target down maybe with time results in A-type risks or related concerns in this situation. And I'm hoping the central bank would go for faster reductions. So what are our expectations, inflation-wise or neutral interest rate? In fact, the work that we've published and the report of the central bank contains all those discussions related to impact on economic growth. We have only been mentioning positive impact because in our estimates reduction was not just a mere goal in itself, but it was trying to make our goal more compatible with the stability of the prices related goal, which means that impacts here are more predictable, less volatile environment, we thought, more predictable environment, more promoting for investment, more conducive, etc. So all of those important factors that we may have in this case have been mentioned in our report. Now, as regards the specific action in monetary policy, our colleague was asking what could have happened to the neutral. Well, in result of all those actions materializing, we might elaborate the approach on how the monetary policy should be unwrapping. And I said that the next action in the monetary policy in this period would completely depend on how that all is expressed in estimates for the inflation. That depends on the credibility towards the central bank. If provisionally, and the simulations are there in the report, if provisionally it doesn't change any behavior among the market players, then the actions of the central bank will move towards strengthening, if it happens in the short term, of course. If that's going through very, very calmly, meaning considering the reputation of the central bank, then the expectations of everyone are adjusted and it happens quickly, then we will be looking into reducing it quickly. So the results of these two simulations are published there with all the policy action that you can see there, but this is just an approximate description. The last question, very quickly, and we'll wrap up. Okay, just a question in corollary to what Edgar asked. Just to understand the overall trajectory of the interest rates of the central bank for the nearest future, what would be your explanation of the decision, yesterday's decision of central bank to reduce it by 0.25%? Is that because of a restraint moving towards extenuated or vice versa? Of course, in consideration of all the signals that you've been receiving from the economy, the current level of inflation, which from the second half of 2024 is much lower than the target and all the scenarios that have been discussed in the board. So the neutral. Doubtlessly, there are uncertainties related to that level of neutrality. That uncertainty emanates from factors influencing the neutral. So the perceptions of the board related to the level of neutrality are not final. There's some ambiguity to it as well, but consensus-wise, you can see things on the chart. In fact, the midpoint is the yellow curve, the highest probability. If you consider a number of components that could push it higher or pull it down, then it may be different, but consensus-wise, it's the yellow line, yellow curve. So in this regard, 7% is quite close to the medium of the neutral. But of course, there are members of the board who think that we are already in the development zone because they have more lucrative perceptions, and some members of the board have more pessimistic attitude, given that the real effective currency rate can become stronger and stronger and result in lower interests in the territory of Armenia, given the expectation that our currency is going to become stronger, for example, which will allow less income in AMD that we would be offering to foreign investors specifically. So that means lower. Now, perceptions are different in this regard, but consensus-wise, yes, we're close. We're close to the neutral, to the level of the neutral. And finally, let's note an important fact. Also, univocally approved in the board, reducing interest rate in other plain conditions means promotion. So we have to compare it to the neutral to say that the cycle of monetary policy is extending or rather shrinking, or where we are in general. But reduction, decrease, means incentive, and it's important to write that down as well. So, but neutral interest rate, I want you to note that for yourself as well, that it in fact is one of the most important factors contributing to uncertainty at the board. So judgments in the board related to A types and B types are, by the way, public, and neutral rate is the generator of uncertainties. But the overall picture is that we're close to the median, and reduction of interest rate independently is promotion for economy. Thank you. Dear colleagues, thank you very much. That will be it. We'll be communicating data on the next meeting. Thank you.